you very much for joining. Welcome all for today's autumn budget review. I've been told to note that it is being recorded today, so if anyone you know has been unable to join, there is a recording available. There'll be a number of speakers today, but we're obviously keen to get any questions that anyone might have. So there is a Q&A icon, I think, at the top of your screen. So if anyone's got any questions, do pop them in there. We'll try to answer them either as we go or at the end. Some of those questions might come through as anonymous. So if you're happy to pop a name on, in case we don't get to it in the session, we can contact you afterwards. So in terms of today's seminar, my name is David Maslam. I'm the head of tax at Old Mill, and today I'm joined by colleagues Tom Parry from Financial Planning, Steve Martin and Marketa Pasova from the Corporate Tax team. And we're going to talk to you, try and cut through some of the noise that's come out both before and after the budget. The purpose today isn't just to shout out the headlines, which most of you probably read already, but really to give you to cover off some of the critical aspects of the budget that we think will impact our clients. We will start off on the personal side of things because we know that there's a number of pure individuals on this call, but that leads in quite nicely to owner managers and ultimately into businesses, which we'll cover off in the second half of the presentation. Before we get on to the detail, I just thought some general commentary on the budget. I think for a government which came to power with an economic plan based on growth, it's been pretty difficult to see in two budgets so far what's been within them that's actually pro-growth in terms of measures. I try not to play party politics, but I do find it difficult to see what their economic growth plan actually is. I think it's fair to say there was very little in this budget for the entrepreneur to cling on to and to feel enthused about. And indeed, you know, the standard approach to setting budgets these days, with this constant leaking of potential things they might do, which then get taken across the media, where they then assess the reaction and decide whether that's a policy they're going to follow or not. And that seems to have been the way of doing things from the previous government as well. But it doesn't give you great confidence that they know what they're doing, if that's how they're setting tax policy. As a tax nerd, it was disappointing that there was very little in the way of actual tax reform in the budget. As one of the commentators in my industry said the other day, you know, if a government with this majority, with an economic hole of the size that it claims we have, you know, if under those circumstances they're not brave enough to do proper tax reform, then really there is little hope that they ever will be brave enough to do it. I did get excited at one point when the Chancellor said the UK tax system is not fit for purpose. And I thought, oh, we're going to get some reform now. We're going to get something that's fit for purpose. But in the next sentence, she introduced 7 new income tax rates, which to me kind of makes the system even less fit for purpose, not better. And strangely, what struck me talking to many clients in recent months and, you know, after the last budget, the number of people actually said to me, look, do you know what, if there is a hole, just stick income tax up 2% and just get on with it. No one wants them to do that, but it's kind of just get on with it and do it. But that, of course, isn't what we got, and their manifesto pledges probably wouldn't allow that. I think what we got in wider terms, probably demonstrated by a couple of charts. So if we just flick over to the next slide, please, and thank you very much. The first slide looks at by year when the tax increase is coming in, because this is clearly a tax raising budget. But when does those tax rises actually kick in? And actually, here we are in 25, 26, very little in the first couple of years. It's all back end loaded into 29, 30 and 30, 31. And you kind of ask yourself, well, why is that? If we've got a hole, why don't we just sort it out now? And maybe it's just you can't do that politically. Maybe their manifesto, they've ruled out tax rises, rate rises. They can't do that. And reality, if you're not going to do those things, there's not many levers left that you can do immediately. And anything you do put in place, and some of these things we'll talk about today, is going to take time. It's either complex and just can't implement it immediately. So it's very back-end loaded tax rises. And the other thing that comes out, if we move on to the next chart, is what's actually going to raise those taxes, and which measures. So just looking at the second chart, which looks kind of similar in terms of where all the bigger bars are, but is actually quite different. And really just look along to the right, and this is just a continuation of what's called fiscal drag, where we're not putting up rates, but we're just going to leave thresholds exactly where they are for longer and longer periods of time. And of course, we're already in fiscal drag, so that's why to get further impact from it, it has to be pushed further down the line. So they're the two striking things in general terms from the budget. But let's get into some of the detail, and I'll now hand over to our panel of experts, starting with Tom Parry, who's going to talk about some of the measures affecting personal financial planning. Thank you.
Thank you, David. Thank you, everybody, for joining the seminar today. As David said, I'm in financial planning, trying to cover off a few bits relevant to personal financial planning primarily. And actually, there wasn't a great deal. There wasn't a great deal to say. I think the overall budget was a bit bland, and that, to be honest, came as a bit of a relief following what has gone before. But as sort of David alluded to, it's been far from perfect. But there was one piece of positive news, if you were going to define everything as positive or negative, and that would be the headline. You're in trouble when the headline for something to talk about is the cash ISA. But yeah, they have announced changes to ISA allowances and how they can be used. And that is at the minute, everybody in the UK is able to put £20,000 into an ISA. Cash ISA or an investment ISA, or a combination of the two. And they've said that from 2027, your ability to put funds into a cash ISA is going to reduce. It's going to halve. It's going to be limited to £12,000 for those under 65. And I can sort of see where they're coming from with this policy. I guess the expectation is that if you have individuals that are currently used to funding their ISA up to £20,000 each year, and that's currently going into cash, so it's not really going anywhere, it's not being used, it's not driving the economy forward, why not bring in a mechanism to encourage people to use the investment ISA allowance and put funds into British companies and get the economy going, and get people to think about their money a bit more. What use is there having piles and piles of funds in cash, particularly with inflation the way it is? I think there may be some good to come out of it, but in terms of the practical difference that it will make, I'm not sure it's going to be. It's not sure it's going to be huge. The first off is to say that the change only impacts those under age 65. And, in my experience, those that have a preference for cash ISAs over investment ISAs tend to be older generation, so over 65. And also, it's not that many people that use the full £20,000 allowance into a cash ISA at present. That said, I think it's good in theory, even if it's going to make little practical difference. And worth noting that the junior ISA allowances and the child trust fund, as was lifetime ISAs, their allowances are going to stay the same, which I think is good. It encourage more and more people to save. And I was also pleased to see that there's going to be a consultation on the lifetime ISA. So over the years, we've had lifetime ISAs and help to buy ISAs, which are sort of investment vehicles that are trying really to save two problems in one. It's an alternative way of saving for retirement, other than pensions, but it's also trying to help people build a pot to be able to buy a house. And those two objectives have very different timescales, and so whether they can be fixed by the same investment tool, I think is questionable. So yeah, it's good that that's under consultation. So I think generally positive, although it's not going to make a huge difference. As ever, devil will be in the detail, and one potential hitch I can see would be in the sort of implementation of this. How are investment providers, how are ISA providers going to monitor who has used a £10,000 allowance and who hasn't, or £12,000 allowance? Likewise, at the moment, the rules permit you to fund an investment ISA, and then at a later date, if you wanted to, you can convert that to a cash ISA and keep the ISA status, keep it tax-free. We're not sure how that may be changed in future. So I suppose it's watch this space. That was the highlight of financial planning point of view. The next item to talk about is salary exchange, and I think this is really confused, this introduction. The core nuts and bolts of it are that at the minute, if you are in a salary exchange or salary sacrifice arrangement, you have the ability to effectively give up or sacrifice a percentage of your salary in return for a benefit of at least equal value. And for most people, that's a pension, because it's really easy to say, well, I give up £100 of salary and I get £100 of pension contribution instead. The benefit of doing it that way is that because it's no longer salary, you and your employer, you no longer pay national insurance on it. So there is a national insurance benefit to both the employee, both the person saving in the pension, and the employer who would be making the facilitating the pension contribution. And the government has said they're going to limit that, limit the bleed on national insurance, and it's another sort of trimming away at the success or the viability of pensions. That's not to say it's gone too far. You know, I think pensions are still fit for purpose. They should still be the first sort of savings vehicle you look at for long-term saving. But they are becoming slightly more attractive because these benefits keep getting chipped away. But one thing that did strike me is that this rule change is due to come in from April 29. Which, you know, the way things are going, there's no guarantee that the existing government will still be in power come 2029. So you wonder why they put this change so far in the future. Again, maybe it's down to the implementation of it, and nobody really knows how it's going to be implemented and how it's going to be monitored. And it makes it really tricky to give advice around this area, because the landscape will undoubtedly change in the next 4 or 5 years. So I think for now, for those of you saving in a pension, if you have a salary sacrifice arrangement, great. It's still fit for purpose. It still gives you a little national insurance boost. It's just not quite as good as it was. And for employers, for those of you that have businesses and are employing people, again, if you have an arrangement in place, then by all means continue it. Unfortunately, the national insurance saving will be less than before. If you're thinking of setting up a salary sacrifice arrangement for your staff, I think perhaps chat it through with somebody that understands the area. You can see the level of change in the table overleaf, and essentially this is saying that if you have somebody saving £6,000 per year into their pension, so £500 per month, of that, only the first £2,000 is going to attract a national insurance saving. So whereas currently, if you're a basic rate taxpayer and you're saving £500 per month into your pension, you get an extra boost of £480 per year. Come April 2029, if the same regime and same legislation's in place, that's going to reduce down to 160. And you can see the knock-on effect for higher rate taxpayers and employers as well. So all in all, I think salary exchange, salary sacrifice, it gives me something to talk about, but it's a little bit confused. The other thing that I have on the agenda for financial planning was around venture capital trusts. Again, these are fairly niche. They're sort of specialist investments. The concept is that the government wants to drive investment into new companies, new areas within the UK, specific sectors, specific areas. But if you're an investor and you're contemplating putting money in a new or a young company, that comes with added risk. And so to compensate you for this risk, to encourage the type of investment that they want, the government give a tax relief, a tax benefit for putting your money with a VCT. This relief is currently 30%. It's going to be reduced down to 20%. And again, I think it's a bit confused. I'm not sure what they're trying to achieve with this change. The amount of revenue it's going to raise is negligible. It's about 120 million, which sounds like an awful lot of money, but for UK PLC, it's nothing. You'd have noticed on David's previous charts, VCT didn't even feature. And on the one side, you might say, well, it's, if they're trimming around the edges of pensions, maybe they want to. They're expecting people to contribute elsewhere, and so they don't want to have a bleed of tax relief in another area. But I think confusing pensions with VCTs is quite dangerous. VCTs are generally higher risk. The other change they have made is to try and reduce the risk in a VCT by allowing larger companies to qualify for the relief, and therefore investors can access larger companies, therefore hopefully more successful or more likely to succeed companies, and still retain a tax benefit, but I'm not sure where it sits in the whole economic scheme of things. So I think it's a niche investment for those of you that might consider an investment in a venture capital trust. It's the same process as before. It's consider the risk with the reward and if it's right for your personal circumstances. And that was about it from me. So I'll pass back to David, who hopefully has something more interesting to say.
Thank you, Tom. If we can go over to the next slide. Thank you. So I was just going to talk briefly about some of the announcements regarding personal taxation. I'll start with the kind of annual taxes, income tax, NIC, and then move on to some of the capital taxes. And of course, mention again the government's manifesto, where they really did kind of hamstring themselves in terms of what the levers they could pull, which was, we are not going to increase income taxes for working people, whatever working people means. So no surprise that rates again were left as they are, but what we've got is this extension of fiscal thresholds and allowances where they are, and freezing them going forward. And despite claims that there were no income tax rises, I counted 7, which I'll come back to in a minute. We've also got the rise in national minimum wage for under 21s, which is a further pressure putting on some of the business clients in terms of not just their payroll costs of the under 21s, but the kind of uptick impact that has on the rest of their payroll. So if we start with personal allowances and thresholds, yes, what we've got here, so we're talking about the personal allowance, the £12,570 of tax-free income that everyone gets every year. The basic rate band, I won't read all the numbers off the slides, you're perfectly capable of reading, and the higher rate tax band are all due to be left where they are now until 2031. So they were due to be left at those levels until 2028. We've now got a further 10-year freeze at that level. These thresholds were first frozen since 2021. That will be 10 years of no inflationary increase in those thresholds, assuming this plays out. That's quite a long time, and it's not that long ago we had inflation running at 10%. That's 10 years where these allowances will be left where they are. One thing that never gets a mention but is relevant to some is the £100,000 personal allowance limit, for want of a better phrase. But this is the annual taxable income that an individual can have, above which they start to lose their personal allowance. It tapers away. Now, this was first introduced in 2012, but again, it's just been left at £100,000 ever since. It wasn't really mentioned in the budget, and so one can only assume that it's going to continue to play out at that £100,000 limit. that would be worth about 140,000 now, allowing for inflation since 2012 if it had gone up, but it still sits at 100,000 pounds. And it's relevant because, you know, anyone earning between 100,000 and 125,000, your marginal income tax rate is about 60, can be 62%, and for anyone actually with child tax credits, or child care credits, I should say, a pay rise of £1 can cost them an awful lot of money. Alongside the freezing of the income tax thresholds, the national insurance thresholds will remain frozen for the same period. I'm running some brief numbers. As you can see in the bottom slide there, an employed person earning £50,000 now, assuming an inflationary increase over the period between now and 2030, they'll end up paying £1,200 more tax a year. So you can start to see why this policy of freezing thresholds has such a big impact. It's forecast to raise an extra £12.5 billion a year by 2030-31. So the allowances, that's them being frozen. If we look at rates, and as I said, of course, no increases to income tax on workers. What we have seen, though, and I alluded to new income tax rates, we've seen increases in tax rates for dividends, for property income, and for savings income. Just to make life really easy, because we have a very straightforward tax system and we'd like to keep things simple. These are all brand new rates, and they're also being introduced at different times, because that's really helpful, isn't it? So increase in dividend rate, that's the most pressing one. So from 6th of April 2026, the dividend rates for people in the basic rate and higher rate bands are going to go up by 2 percentage points. So that's to 10.75% and 35.75%. The upper rate is not going to change at all. So that's dividends. That's coming in April 26. Coming in April 27, though, are the similar 2 percentage point increases to tax rates for property income and savings income. These apply to all rates, whether you're basic rate, high rate, or upper rate. It does feel like governments of all hues don't particularly like landlords at the moment. We saw, starting with George Osborne, I think it was, a continued kind of attack on property owners and landlords, largely being hit with the restriction on interest relief, where if you're a higher rate taxpayer, you'll pay higher rate tax on your property income, but you only get basic rate relief on your interest. So this feels like another kick in the teeth for landlords. Excuse me. I'm pleased to say that the basic rate relief that you'll get on your interest will also increase to 22%. We've had a lot of requests over the last few years from property owners or approaching us asking, should we incorporate our property business on the basis that that kind of restriction rule doesn't apply to companies. We have incorporated some. For many, though, the capital gains tax and stamp duty land tax on the way in as part of incorporation means it's just not feasible. The one-off tax of doing it outweigh the annual taxes going forward. I would warn, there are a lot of unregulated advisors out there peddling schemes to get round the CGT and SDLT. They don't work, so please don't be tempted to follow someone on Facebook telling you that there's easy ways around that. That's property rental savings, taxation on savings also going up to 2%. And then finally, the one that comes in by the back door, at the moment, your personal allowance, this is the 12,570, you can offset that, or a taxpayer can offset that in whatever's the most beneficial way. But from April 2027, that's going to change so that you offset your personal allowance against your employment income, trading income, and pension income first, leaving these more highly taxed incomes perhaps exposed. This leaves us with a somewhat ridiculous situation in terms of actual income tax rates. rates we'll have in 27-28. We'll have 0%, 10.75%, 20%, 22%, 35.75%, 39.35%, 40%, 42%, 45%, and 47%. I mean, that's just utterly ridiculous in my view, but that's what we'll be dealing with. I think what's clear from those changes there was a lot of talk about, will the government introduce a wealth tax? And you have people like Gary Stevenson online kind of saying this is the way we've got to go. The truth is wealth taxes don't work. They take too long to implement and they don't actually generate revenue. But what you can see from above is you can see the kind of the desire to tax wealth, and in this case, tax the returns that are generated by wealth. And also what's not mentioned on here was the additional council tax levy for properties over £2 million announced at the same time. So you can definitely see that kind of desire to tax wealth as opposed to workers coming through. If we flick over, I'll have a look at capital taxes. So that was the annual taxes. So capital taxes focused on APR and BPR there. But I will also touch on capital gains tax. I can't remember the last time in a lead up to a budget that there wasn't massive speculation that the rates of capital gains tax were going to go up, maybe to income tax rates, or inheritance tax was going to get worse. And clearly they did last year. And you know, CGT rates were increased this time last year, and the budget was dominated by the proposed changes to agricultural property relief and business property relief, and to be honest, that's dominated the tax landscape, I would say, for quite a lot of our clients over the last 12 months. It was then quite a relief that they left these taxes alone in the budget this year. There was some further speculation that further proposals might be announced. Fortunately, they didn't. I think most people will be aware of the changes to agricultural property relief because it just has been in the news so much and the impact that has on farms. We have found that the understanding of business property relief and the fact that these changes apply to non-farming business has been less widely reported and less widely understood. But broadly, APR and BPR were reformed in the 1990s, really to provide 100% relief and allow business owners and farmers to pass their businesses and their business assets down through the generations without incurring IHT. They have been abused, and and APR and BPR have become a shelter of wealth from IHT. So you can kind of understand why the government might want to address that. I don't think they've addressed it very well. And what was announced last year, for those who've slightly forgotten, is that 100% unlimited relief will reduce from the 5th of April 2026 to a £1 million allowance where you get 100% relief with only 50% thereafter. There have been calls to increase that £1 million that they've been ignored, but there was also quite a lot of lobbying about making those allowances transferable between spouses, and it was pleasing to see that was announced. So a husband and wife can effectively have £2 million of relief. I think the final thing I'd note here is many of our clients, many taxpayers will have taken action over the last 12 months to try and address some of these changes. A number of people will not have done that. They might have been waiting to see whether this actually comes into legislation or not. I think, just to be clear, and this is not to say it's the right thing to do to start gifting away stuff, but if people are considering gifting assets, and quite often we talk about gifting assets into trust, basically you do have until the 5th of April to transfer an unlimited value of qualifying assets into trust without crystallizing lifetime IHT. After that date, if you were to transfer more than 1.65 million of BPR qualifying assets into trust, you will crystallize lifetime IHT. So a bit of an incentive to get on with plans if you're minded to do that. My final slide was just going to be a bit of a segue. Oh, sorry, there was national minimum wage. forgot about that. Yeah, so that's going up from £12.21 to £12.71. Again, what we've seen from business owners over the last 3 or 4 years, there's been successive increases to national minimum wage and living wage. And for a period, I think most employers were able to, they had enough gap between employees at the very bottom end and almost like the rest of their staff, and they were able to there's enough gap to just apply those increases without impacting their whole payroll base. Actually, that gap's just been continually squeezed, and what we now see is that having a knock-on impact. You're not just putting your wages up for your staff who are on minimum wage. It starts to impact from there as well. So yes, my final slide was just on a bit of a segue between the personal and the business, because most of our clients are owner-managed businesses, so there's a business involved, but there are people and families at the top of them. Just a few initial planning thoughts as we head towards the 5th of April. And an ensuing 2% increase in dividend tax rate for any SMEs who are running their businesses through companies. There must be a decision to make. Do you perhaps bring forward some dividend to take place before the 5th of April and lock in the current lower rate? Or do you continue to and push it out, accepting you're going to pay more tax, but your tax due date goes back a year? The age-old question around salary and bonus versus dividend comes back to the fore again. I think running some brief numbers, I think most people will still be the most tax beneficial structure would still favour dividends, but the level of salary or a level of income, I should say, at which it starts to tip back towards salary has been reduced dramatically. I think it was about £500,000 in current legislation, but going forward, I think that's going to come back to 300,000. And then finally, in terms of other extraction for limited companies, don't forget the other modes in which you can extract hard-earned profit from your companies. Tom talked about pensions. I've got to be careful I don't give pensions advice because I'm not a regulated pensions advisor. They remain the most tax efficient way of extracting profits from your business. You leave £1 in your business, 25% of £1 of profit, 25% of that will go in corporation tax. You pay that into your pension. You're saving 25 pence going to HMRC. So pensions remain extremely tax efficient. Interest on loans, if you've lent money to your company, the company owes you money, you are able to charge interest on that, a way of getting money out of your company without NIC. Similarly, if you own a property that you rent to your business, that can be an effective way of getting money out. I won't go too much into overdrawn loan accounts. It can work, but I wouldn't recommend them day to day. Ultimately, do seek advice and think carefully about your steps and take advantage of the opportunities available. That's a bit of a segue from the personal side of things to business, and so I will now bring in Steve Martin and Marketa Pasova, who work in the corporate tax team with me, and they'll talk to you about business tax.
Thank you, David, and good afternoon, everybody. Business taxation, there's some interesting, if not headline-grabbing changes to talk through. Perhaps an element of the budget that was pro-growth, arguably some of these measures, particularly around capital allowances, I think could arguably be argued as the pro-growth part of the plan. Albeit there are certainly some takeaways and some on one hand taking some tax as much as giving some opportunities for tax saving and investment. There's a few areas I'd like to cover. The first one on capital allowances, that's a summary of the schedule for business taxation that we will talk through. Moving on to capital allowances, some interesting measures here. The main one, which is probably the headline grabbing one for unincorporated businesses in particular, is a new capital allowance, and that applies from the 1st of January 2026. I think that date in particular, as much as the allowance itself, is noteworthy. So not effective from the date of the announcement of the budget, and not effective from the start of the fiscal year, 1st of April, but 1st of January, a completely new date to keep us on our toes. So this is a 40% first year allowance, which will apply to qualifying capital expenditure, which I think is of particular interest to unincorporated businesses, so non-company businesses with large elements of capital expenditure, those that currently spend more than £1 million on capex, which is the threshold for the annual investment allowance, AIA, I've referred to there. Those businesses will currently be able to claim 100% capital allowances under the AIA regime, but anything in excess of that is subject to the usual writing down allowance claims only. So this gives an opportunity to claim 40% first year allowance on effectively the excess. It's not perhaps of much relevance per se to corporates, because companies have an alternative regime which is called full expensing, which has an unlimited amount of 100% relief already. But as I say, unincorporated businesses don't have access to the full expensing regime. So I think this is really quite useful for larger, let's say, partnerships, LLPs, probably to lesser extent sole traders, but certainly unincorporated businesses should see some benefit here, and money being spent on plant and machinery in the UK will drive some economic activity and therefore growth. So this is, I think, a pro-growth and positive move. The other niche element to the rule, which is certainly noteworthy for some, and this is where both company and unincorporated businesses will benefit, is that the first year allowance will be available on leased out assets. Now that is different to the rule that applies to full expensing, which is restricted if assets are bought for leasing, and that can mean a number of things. And actually HMRC are really looking hard at businesses that buy assets which are not then used by them for their business. So the construction industry is commonly an area where assets are acquired and then hired out to some degree. Clearly in things like shipping businesses, that's also a very relevant thing. Here the first year allowance will apply to leased out assets, so that is a positive for businesses who can't currently claim, say, full expensing. Like full expensing though, this first year allowance will not be available on second-hand assets, so that's something to note. The other change on capital allowances was the quid pro quo taking away with the other hand, which is a reduction on the writing down allowance from 18%, which is the main pool rate, to 14%. That will apply from April 26. That will apply to all businesses. Now, in general, there probably isn't much impact for the type of businesses that we work with, because with the availability of a lot of 100% reliefs in the form of the annual investment allowance and full expensing, and earlier regimes that have given full relief, there probably aren't that many businesses that do have brought forward pools where this will have a material impact. There will be some, but this is largely going to hit the really, really large corporates, the mega corporates, multi-international businesses, banks, those type of businesses where there will be very, very sizable pools, and therefore there will be some tax take as a result of that change. The next change is quite an interesting one, and an area that has been tweaked a little around the edges, but nothing materially until now. Enterprise management incentives, which is a tax regime enabling employers to give equity and equity incentives to its employees. Now, up until now, the enterprise management incentive has always been the most tax advantaged way of achieving that, in that there are limits that are higher than other regimes that exist, enabling you to give equity incentives to your employees. But there has been a cap on the type of business that can use the regime based on the number of employees in the business, the level of assets, and the value that can be subject to share options. So this is a scheme that involves options being granted to staff, and if certain conditions are met, they then become shareholders at some point in the future, which is a good incentive for staff and a cheaper way of incentivizing staff than paying salaries and bonuses principally. So it is a good thing for business too. The limits are increasing, and in some cases increasing quite dramatically. So the employee limit that previously applied is going to double to 500. So you can have a business with 500 members of staff and still now benefit from this regime, which has typically been associated with the smaller end of businesses. There are some regimes which listed businesses can use, but this is a sort of an SME category relief. The asset limit is increasing very significantly from 30 million to 120 million. So you would imagine that would include now a very, very large number of SME and possibly quite large medium-sized businesses too. The limit that perhaps is of less interest in general, in my experience, having dealt with enterprise management incentives for a number of years, is the value of unexercised options increasing to 6 million. That was never really a threshold that was a problem, but certainly the 500 employee limit tended to be the first threshold that would be hit and prevent larger employers accessing this regime. So that certainly has to be considered a positive. To a lesser degree, in my experience, the 30 million asset limit has not been so much of a problem, but if it was, then increasing to 120 million is likely to bring a lot more employers within the remit of this regime, which is certainly positive. The other extension is that up until now, the rule was that EMI options had to be exercisable within a 10-year period after the date of grant. That will be extended to 15 years. That tends not to be so much of a problem. It does occasionally happen that options are granted and then conditions are not met, typically if the options are only exercisable if there's an exit, a sale of the business. Then perhaps that doesn't happen within 10 years and the options disappear, the incentive goes, it can be a bit of a problem. Extending it to 15 years seems possibly not so important from my point of view. Just to note that there hasn't been a change to the type of business that can qualify, other than these financial metrics. The type of trading company that you need to be remains the same as it was. So there are certain trades that are excluded from the regime. Those rules remain in place, and these rules are all applying from the 6th of April 26, with an element of retrospective effect which needs to be looked through. The other element that has been looked at a lot by HMRC recently on EMI schemes is around the use of discretion in EMI option contracts. Not a subject for today, but if you have an element of discretion being applied by the board, that is a particularly thorny issue that advice should be taken on. Vehicles. What have I got to say about vehicles? Again, a bit of a taking one hand and giving in the other. Zero emission vehicles, there's been an extension to the 100% capital allowance on those and on charging points, which was due to end in April 26, has now been extended for another year. That needs to be said as a good thing. That's encouraging us for our sort of carbon emissions perspective. And plug-in hybrids, this rule about benefiting kind largely as a result of the scandal involving the emissions testing and the emissions manipulations. HMRC have this deeming rule that you will be treated as if you have a plug-in hybrid, regardless of the actual emissions, it will be deemed to be the lowest other than zero, and therefore applying a low level of benefit in kind, even if your plug-in hybrid has got a higher emission that would treated as having a higher benefit in kind. So that's a benefit, and that's being extended until April 28. They're the positives. I guess the only other positive there is the expensive car supplement. So this is known as the luxury car tax, where electric cars are concerned, zero emission cars. The limit at which that duty will start being payable will be extended to 50,000, where it's currently at 40, which again is good news. Some of the less good news: the electric vehicle excise duty that has been announced from April 28, so it will apply to electric cars. We'll have to pay 3 pence per mile. Plug-in hybrids at 1.5 pence per mile, regardless of the amount of miles driven on the electrical or petrol powered engine. There's a separate duty that already applies on plug-in hybrids, and although the fuel duty 5p litre cut being extended until September 26 looks like good news, I suspect it's probably not good news, because that date does not coincide with when the next budget will be. So in theory, there are no more budgets until that deadline has passed. So we should be expecting the government to introduce that 5p duty on top of petrol pumps. That's how it should work in practice. The reality is that governments tend to announce changes all the time whenever they like. So whether that actually could be extended further, I do not know. But in theory, we have a spring statement, which is not meant to be a tax statement in March or early April, perhaps. But the next budget will not be until the following autumn. So this is the last one before that September 26 date. The real background here is that fuel duty and taxation of petrol and diesel cars raises a huge amount for the exchequer. Fuel duty on its own is 25 billion. There needs to be something to replace that money. There are some complications around some of these rule changes. So the mileage is meant to be assessed as part of paying car tax. So when we get to April 28, how many miles are you likely to drive in your electric vehicle? That is then paid either then on the day or over the following 12 months. And then following an MOT, a true up is made. I mean, that sounds like a recipe for disaster. Cars that are pre-MOT, there needs to be some sort of mileage checking, because obviously you don't need to have an MOT. Who does that? Who are you going to pay to do that? What's the integrity of the data? And what about if you sell your electric vehicle? You're presumably going to have buyers saying, well, I need to know how much undeclared duty there is attaching to the mileage that you've done. That sounds like an horrific situation to deal with. So I have no idea how that is going to work through. But these are things that someone in government will have to work out, because I think we wouldn't want to have to do diligence on that as part of buying cars. Venture capital schemes is the next area I wanted to cover. So here we have a situation where thank you, that's the right slide. We have two elements of venture capital schemes. So these are schemes to encourage individuals with money to invest in risky startup or maturing companies, not listed businesses, so typically unlisted businesses we're talking about here. And there are tax incentives for doing so. Tom has already talked about the reduction in the rate for investment in venture capital trust qualifying companies. There hasn't been a change in the tax rules relating to your investment in enterprise investment schemes, or indeed seed enterprise investment schemes, which is the smaller brother of the EIS. So that's where there's a 30% or 50% income tax relief on the investment with a CGT exemption at the back end on the sale. My my slide here is more about the thresholds that are changes. There's been a limit on the size of the business that can qualify, and I guess following in a way the EMI rules about the size of business. From 6th of April, the type of business that can be invested in is going to be much larger, and without providing investment advice, that might mean that they are less risky. In theory, large businesses being less likely to fold. So that's a positive. Most of the limits are doubling in terms of the size of business that can raise the money, how much can be raised on an annual and a lifetime basis. Just a reminder here on, I've mentioned knowledge intensive businesses, so different rates depending on the type of business that is being carried on. You've got your traditional business where old rates apply, your new WYSI, R&D, intellectual property investing corporates, larger thresholds apply, which is certainly something of interest in the sort of the tech community. There are various rules that need to be met. I've covered a few of them there. Probably the main one that is of relevance is the fact that knowledge intensive businesses are able to raise funds within 10 years of their first commercial sale, which is quite a long lead time for a regime that is meant to be for startup and scale up. The normal limit is 7 years, so that's interesting. The point really interesting to note is that it isn't just within that time frame. So if your original business plan as a company says that you're anticipating raising more money at a future date, that can extend your 7-year period. It's often a rule that's not actually known or thought about, and there is a separate ability to claim after that 7-year period if you're going to use the money for a significant pivot, what's known as new product, market or geography rules. There has to be quite a lot of rules passed in terms of how much is going to be raised and what the money is used for. But it is still an opportunity for more mature businesses to still have access to these venture capital schemes. And clearly with investors being able to get some tax relief on the investment, it makes that opportunity greater for the investors. A final couple of minor sort of admin points on other business areas that were covered. Incorporation relief, so this is when you're transferring your unincorporated business into a company. Up until now, if the conditions were met, that the relief from making a disposal and paying capital gains tax on that transfer just happened automatically, nothing needed to happen. Now it needs to be claimed, so that will be an entry in a tax return in some fashion. It seems slightly unnecessary to have introduced this rule, and it feels like that is going to catch people out, which feels mean, if I'm perfectly honest. So that's something that we need to be really careful of. Any circumstance of transferring sole trade or partnership into a company, there needs to be a box ticked somewhere for that to happen. Late filing penalties for corporation tax, all of the penalties are being doubled, where filing dates are on or after 1st of April 26. I'm not surprised by this. Corporation tax penalties have always been £100 as far as I can remember for filing 1 day late, and then another £100 if filed 3 months late. It's not a massive disincentive for businesses to be compliant there. Indeed, £200 doesn't seem like a lot either, but the fact that those are doubling is not a surprise, and they have been like that for at least 20 years. So that's not even really keeping up with inflation on what £100 penalty would have been 20 years ago. And a minor point on transfer pricing, which is that UK to UK company transactions are no longer needing to be assessed within the regime. I'm going to let Marketa now talk about employee ownership trusts and a small point on share exchanges before we close at 1 o'clock.
Thanks, Steve. Good afternoon. I will very briefly talk about a couple of changes to capital gains tax reliefs. So these changes affect some, will affect some transactions, which is an area I focus on. Both of these changes took effect on the budget date. So the first change I will talk about relates to employee ownership trusts. So here we're talking about a trust which is set up for benefit of all employees. It is a business succession strategy. So this employee ownership trust, EOT, basically takes on the ownership of the business, and the trustees run the business going forward for the benefit of the employees. The employee ownership has been proven to increase productivity, benefit economy as a whole in general. So we have a tax incentive in place to encourage people to use the EOT structure as a succession planning strategy. Historically, we had 100% capital gains tax relief where shares in a trading company were sold to an EOT. That relief is reducing from 100% to 50%. So it is still an incentive. The message from the government is, well, we need to curb our costs, but we are still dedicated to this relief. We still want to encourage EOT structures. What's happening is that we're going from a full relief on a sale of shares to an EOT to 50% relief, so half taxed rather than fully tax exempt. It is the effective capital gains tax rate on those sales will be 12%, which is still fairly low compared to some other share transactions, other exit strategies like trade sale or management buyouts or private equity deals. So we are confident that EOTs and sales to EOTs will remain a viable succession strategy. They will be used in future. The tax relief is still strong, even though lower, and there are some significant non-tax benefits to EOT structures as well, which attract some business owners. So that was the first change. The second change, which has been announced, is a slight rewrite to anti-avoidance provisions, which are attached to share-for-share capital gains tax reliefs and similar transactions. So these reliefs are used commonly in demergers, mergers, group reorganizations, and similar transactions. So what we have here, the change is that HMRC now will have a bit more power to challenge arrangements, some anti-avoidance arrangements are put in place in transactions which are otherwise commercial. We still have a clearance facility in place, so we can agree with HMRC before the transaction whether these or that these anti-avoidance provisions will not apply to that particular transaction, so we can get a quite high clarity and certainty on a tax of a particular transaction before it actually takes place. For transactions which are ongoing or were ongoing at the budget date, there are provisions in place to allow these transactions to complete under the old rules, as long as the clearance application has been sent to HMRC before the transaction. So overall, we don't really expect that this change would affect majority of the transactions which we undertake, which utilize these type of capital gains tax reliefs, but obviously applying for the clearance, getting the clearance before the transaction takes place will be more important than ever, and careful planning and careful drafting of those clearances will be very important too. That is pretty much all I wanted to cover, so thank you very much. I'll hand back to David for some closing comments.
Thank you very much. I think time is up. I'll just be very brief and sum up, really. I mean, it does feel like these days that if something lives, breathes, moves, or you can touch it, it's going to get taxed. And I suppose but there are reliefs out there, and there are ways of plotting your way through these things. Our jobs with clients is really to understand, where you are now in your life and where you want to get to, and helping you find that road through to where you and your family want to get to eventually. There's plenty of potholes along the way because they haven't been fixed, have they? And our job and where we can help is to stop you falling into them, and plot your way through. So do speak with your accountant or tax advisor, whoever that might be, and really just make sure that you pay no more tax than you absolutely should. Thank you very much for your attendance today. I don't think I saw any questions come through. I could be wrong on that front.
Sorry, David, there was one question. One question's come through.
Okay.
It's regarding pensions tax relief. So the question, will there be any changes to pension tax relief, either rates or the amounts against which relief can be claimed? So that's probably one for me. And I guess the answer is we don't know. As David said, it seems that tax creep is coming, and pretty much everything in the UK that can be taxed is taxed to some degree. They have been trimming away or playing with pension tax relief for a little while already by reduction of annual allowance, so reduction of the amount that one can put into a pension scheme and receive tax relief on it. They've introduced the taper, which affects high earners. Again, a reduction in the amount that can be put into a pension. So I suppose I wouldn't be surprised if they made further changes to pensions tax relief, but it's not been announced as yet. It's forever a rumour, but until we have some sort of concrete legislation, it's just another thing to be worried about, I suppose.
But as we stand now, the changes that were announced around salary sacrifice are effective from 2029 onwards. So as we stand here now, the situation hasn't changed, and the income tax relief available at point of making contributions, or corporation tax relief if it's a company contribution, are still very much in play. Okay, if there are further questions, then I think you've got contact details there for the various people on this call, so do feel free to either pick up the phone or to email one of us, and we'll happily help. Otherwise, enjoy the rest of your day, and thank you for taking the time to attend today. Thank you.